This Phillips curve, which Professor White went over, is a trade-off between unemployment and the rate of inflation. And if you flip it, it's the trade-off between GDP and the rate of inflation. You get more GDP at high levels of inflation than less at low levels of inflation. And the reason is that the rise in the price level as you stimulate things is supposed to raise prices for the businesses, and they get more money coming in. But the workforce is supposed to not notice for a while, so it doesn't demand a wage hike. So the real wage falls, labor becomes cheaper, output is produced in greater quantity, and if you're in a recession, some of the unemployed workers will get called back, and you're better off in the short run. There's also a notion that even if you get near full employment, if you have a little inflation and the workers don't notice it, even as you're approaching what would normally be full employment, there's a little bit of leeway on the upside, and similarly less output on the downside. So they've got a not such a vertical full employment curve as one that's slightly tilted toward expansion. So they would say, okay, pick the best point on the curve. You're going to have this trade-off between inflation and unemployment. Pick something in the middle where you've got a little inflation but a little less unemployment, and isn't that a good thing? Last week, Professor White quoted from an interview that Paul Volcker gave to a student at Princeton in the college newspaper who kept trying to push him to saying that completely anticipated inflation was not so bad because it didn't have much bad effect, and it would get you some reduction in unemployment, and isn't that a good thing? And Volcker, verbally at any rate, pounded the table and said, no, there's no relationship there. Don't keep asking me the same question. And we'll see why in a minute. The notion that you could trade unemployment for inflation in a stable way and get the best of both worlds, or the least bad of both worlds, and that you could use fiscal policy to manipulate demand and eliminate the business cycle, was always called into question by the classicists, Hayek and so forth, who opposed Keynes in the 30s and 40s. And in the 60s and 70s, when I was going to school, it was Friedman and the monetarists at the University of Chicago. As I say, it's at odds with long-run growth economics where saving and investment are important and are not drains on current spending by consumers, but in fact raise their output and their income so that they can in fact consume more. But the problem is it may not even work in the short run. Does fiscal policy really alter aggregate demand as assumed? That is a question Milton Friedman asked loudly in the 60s and 70s. And a related question is this Phillips curve, this trade-off between unemployment and inflation, stable, or is the Keynesian framework not suited to designing long-term growth policy? Keynes always put it forward as a counter-cyclical measure for the short run. He was faced with a nasty situation in the Great Depression. The Bank of England would not ease credit in a depression, and the Federal Reserve actually began restricting it more and more. And the monetary system and the banking system was just literally frozen. How do you get money circulating? Keynes said, well, let's grab some out of somewhere and give it to people, even if you have to pay them to dig a hole and pay them to fill it in. If the central bank won't create money, let the government circulate it. That was his problem. In a normal economy, that's not happening. So his disciples may have gone too far by trying to use Keynesian theory for long-run growth policy planning. It was not designed to do it. This was a pretty famous article. Friedman and Samuelson being a Keynesian, Friedman being a monetarist, had dueling columns in Newsweek during the early 1970s. It actually helped them sell magazines. The economists were actually on the cover of magazines. Friedman was on the cover of Time. Friedman asked, you can see how long ago it must have been, if the government spends $300 billion and cuts taxes to $250 billion, where does the $50 billion difference come from? The tooth fairy? I showed this slide to some visitors from Germany, and the translator choked on it because they don't have the tooth fairy in Germany. And I said, well, try Santa Claus. And she tried that, and everybody laughed. So anyway. Okay, what Friedman was saying is fiscal policy can't shift aggregate demand. He explained it this way. If the government cuts taxes and has to borrow the $50 billion back because it hasn't cut spending, either it has to, let's say, give $50 billion in tax cuts to this half of the room and borrow $50 billion more than it was before from this half of the room, and somebody was going to have spent that money anyway, having it gone through the credit markets to be used for investment or consumption. So we take that away from you, and we give that to you, but the total amount of money out there to be spent hasn't changed. Same thing holds true for spending increase. If you raise spending and borrow to pay for it, or if you raise spending and raise taxes to pay for it, you've given money out with one hand, but you've taken it away with the other. Friedman denied that the demand curve shifted, just from the point of view of the Treasury having to sell the bond. The other way of looking at it is a little bit more complicated. We've had other economists try to make that simple example more difficult. It's part of what we do. The other suggestions for why the demand curve wouldn't shift would be crowding out, that the very active borrowing would raise interest rates, and the higher interest rate would discourage investment and consumption by as much as the tax cut had boosted it. Then there's the Bob Barrow approach called rational expectations, which is that people know that the government can't run deficits forever, at least not ever expanding deficits that rise faster than the GDP, so they know that the tax cut is going to be followed by a tax increase down the road. Now, if you're going to have to eventually come up with the money to pay the higher taxes, you'd better save your tax cut, not spend it, because someday the bill is going to come due. I'm not sure people are quite that rational, but it's one of the explanations that's given. And the final one that has some merit, because, and we'll show why in a somewhat modified form later on, is Friedman's permanent income hypothesis. If you suddenly get a tax cut and you're not sure it's going to last, you probably don't move from the small house to the large house or take the kids out of public school and put them in private school. You're not sure that that income of yours is going to be up there higher permanently, so you don't rush around to change your consumption patterns. Consumption is sticky. Therefore, you're not going to get much of a change in demand. When we had the tax rebates recently, and the same thing goes back to the earlier versions of this in the Carter administration and the Ford administration, when you simply do temporary tax cuts, you probably don't get a big boost in spending. It goes into the bank or it draws down debt. And in the last instance, consumption scarcely moved when we had the big stimulus. And this is typical. And it supports Friedman's permanent income view of the world. And so back in the day, we had no examples of it, but then we had the mid-70s attempts, and we had the early 2000s attempts and the more recent attempts. So we now have 3 examples where it didn't work. Okay, so what's Friedman saying? This neoclassical view of the world, he says, look, if you boost aggregate demand, you can do it only by printing more money. The Federal Reserve comes in and buys that $50 billion in debt. It creates new money. The banks have more money to lend. The money supply goes up. People spend some of it. So monetary policy can tinker with demand. But do you want it to do so? Suppose within a reasonable length of time, after markets have cleared, you're back at full employment, and you try to boost the inflation rate or the price level with money growth to make a trade off the Phillips curve to squeeze out a little bit more GDP and a little bit lower unemployment. What happens? The demand curve will go up. You'll move from E0 to E1, but you're above capacity. And as soon as the workforce catches on to the fact that the price level has risen, they're going to want to raise. So costs rise by the same amount as the price level. The supply curve shifts by the same amount as the demand curve. Have you gotten anywhere? Well, you've gotten a higher price level, and if you've got some of that government debt out there, you now devalued it a little bit, but it's not going to give you more GDP. If you continue to raise the money supply at 3% a year instead of 0% a year, let's say, you're going to get an extra 3% price gain every year, and that's inflation. It's not just a one-time rise in the price level, but ongoing. And as soon as people catch on to how much the inflation rate has risen, they're going to keep pushing the costs up, the wages up, the interest rate that a lender will demand up by the inflation rate. And as soon as they catch on to the higher inflation rate, they're going to negate the growth effects. And the only way to get more growth out of that system is to have the inflation rate go up, and accelerating inflation. But as soon as people catch on to the acceleration, during the hyperinflations between World War I and World War II in Central Europe, Austria, Hungary, and so forth, Germany, and more recently in Latin America, or in Zimbabwe. I have a Zimbabwean note that has $1 trillion Zimbabwean dollars or pounds, whatever it is, on it. And it's purely decorative. There's just no value to it. But if you try that sort of thing, you're not getting growth out of it. And that was Friedman's point. Don't use monetary policy to try to goose the economy, because all you're going to get is an increase in the price level, and if you keep it up, all you're going to get is higher inflation. So that was the original Phillips curve, which seemed to show that inflation reduced unemployment in the 1950s and 60s. But in the 1970s, the inflationary 70s, guess what? Those points didn't lie on the Phillips curve, and in the next slide we can trace moving Phillips curves as people got used to higher inflation rates. People were catching on, and the trade-off was evaporating.